Hello, everybody. This is Steve Rose, Art of Wealth Management, here with Ryan Detrick. And before we get started, Ryan, I do have to, compliance has gotten on me a little bit. I have to give my full title to everybody, even though all my clients know who I am. So I am the founder, CEO, as well as certified financial planner, wealth advisor, all those different titles. I don't know which one they want. So I'm just going to say them all to make sure
Same
we get
all.
through. And with me, as always, is Ryan Detrick, Chief Market Strategist of the Carson Group. Make sure I get your full title in there as well. So, Ryan, thanks for spending some time with me, catching up. The last time we spoke, things were a little shakier, to say the least. So, this is good timing. Also, good timing because you guys just released your mid-year outlook.
Yeah.
Uncharted Waters is the title of it. It was a great write-up. We're going to be sharing that in our. We have a newsletter coming out as well as some links to it. One of the things that really jumped out at me, which it didn't surprise me, but I think it'll surprise a lot of people, is your continued outlook on the equity markets, right? Like you guys said, hey, we could still see double digits in the S&P. Why are you still seeing that?
Yeah. Well, first off, thanks for having me back. And it is a lot different. Stocks are up well over 20% from the last time you and I spoke. And yes, compliance. My title is Chief Market Strategist, so I think we're in the clear with the
Good.
correct titles. At the start of this year, we said the S&P 500 would gain between 12 and 15%. So a pretty solid year. Yeah, not as good as the 20% we had 2 years in a row, but that's all right. But we also said, I know Steve, you and I talked about this probably 6 months ago. Be open to the idea that we could have some time in the first half of the year as much as a 15% peak to trough correction. Now we had more. We get it. We had more, but we said we could. It was just due. We got a couple years without a lot of volatility, and then Liberation Day happened, and the near bear market, and all that April volatility. But the good thing about it, we've come back, and we've come back as quickly as we went down, Steve. We've gone back higher. I've maybe used this before. I'll use it again. It's like a beach ball under the water. Take that ball under the water, let it go. It starts to get a lot of momentum. And to keep this high level, when we get more in the weeds of it, we simply do not see a recession. We think earnings are going to continue to surprise to the upside. Inflation isn't really a problem. Now, maybe the Fed's in a tough spot. They probably aren't going to cut very much. But at the same time, we still think this is a bull market, and it's going to probably be a good second half for investors.
I love it. And you already started queuing up where I wanted to go is, there's a lot of talk about the Fed right now.
Yeah.
Obviously the president is talking about Powell,
Yeah.
his, position, whether he's going to stay or not. So originally, start of the year, we were all of the mindset the Fed probably should cut
Yeah.
and they probably will, but that tune is changing a little bit. Can you expand on that?
That's right. Started this year when we were looking at a lot of the inflation data on our team. We said, boy, shouldn't the Fed probably be cutting here? I mean, wages are still solid, but they're coming back. Inflation expectations are coming back. Egg prices, fortunately, have come back a lot. There's a lot of progress is what I'm looking for. I almost said problems. That's not true. Progress on the inflation front, but the Fed didn't cut. And now they're in a tough spot because of the tariffs that are coming. There's potentially higher prices that are coming. And Jerome Powell's been very clear saying, listen, we're not going to be cutting interest rates when we think there's a potential for higher prices coming on the other side. Because let's not forget, in 2022, you could argue, and I'd kind of be in this camp, Powell's a little bit late. He probably should have been hiking rates a little bit sooner, maybe late 21, early 22. Then we had that massive inflation. It's kind of behind the eight ball, really had to hike rates. So his legacy is on the line. You mentioned, yes, President Trump wants to fire him. I mean, that's literally the headlines. President Trump, who knows? Maybe by the time people hear this, they've done something there. But the reality is his term is up next May. All right. Now, who gets to pick the next Fed chairperson? The president. I'm pretty sure you have to check a box that says I'm dovish and I'm going to be cutting pretty darn soon. So markets are a forward-looking mechanism. Maybe the Fed cuts once or twice the rest of this year, which I think makes sense. Will they cut, three, four, five, six times? No, probably not. The honest truth, though, is we get into next year and inflation kind of remains calm-ish, which we think it will. Maybe we have more dovish Fed next year. And again, that can kind of keep this economic cycle of growth going.
Beautiful. And so, the thing that always comes up with my clients, right, is we talk about what should we be looking forward to, right?
Mhm.
Like this market has been pretty tumultuous,
Yeah.
peak to trough. We've had volatility that doesn't always feel good, but is fairly natural. We don't like it. So looking forward through the end of the year, what are one or two things that you would kind of
Yeah.
point at to say, hey, you should really keep your eye on this. That will help kind of pave the way for what kind of year we're going to end up at.
Yeah, well said. So listen, the S&P is up about 26% off those early April or mid-April lows. So that's extreme. That's an extreme rally. I don't think it's saying anything probably we don't know. Be aware that volatility is the toll we pay to invest, something we like to say. And maybe we get, another 7 or 8% peak to trough correction at some point. Perfectly normal when you have this rally. Now, a couple hopefully positives for everybody out there. I call this the sweet spot. I know a lot of golfers, right? Out with you there in Nevada and out the West Coast there, a lot of golfers. The sweet spot when you hit that ball perfectly feels really good. Well, the S&P is not that different. When the S&P is up between 5 and 10% at the middle of the year, like we were this year. Yeah, it was a round trip getting there, but S&P is about 6% at the middle of the year. The rest of the year has been higher 14 out of 16 times with above average returns. Now, one more. Hopefully good news to look forward to. When the S&P is higher in May and June, which normally are kind of weak-ish months. Well, they were up this time in a big way. When the S&P is higher May and June, the rest of the year has been higher, ready for this, 15 out of 16 times. Momentum is a real thing. We have momentum to this market. Could we have another big trade war and big trade policy? Yes, we could. Could there be more geopolitical concerns? Yes, there absolutely could. That's why we keep a diversified portfolio, have some stocks, have some bonds, some cash in there. That's okay. But we would still suggest being overweight equities like we have for a couple years now. As again, the second half of this year, we still think it's going to be positive. And I'll tell you, Steve, we think stocks can probably gain 15% this year, which still means there's some good amount of upside, all things considered.
Beautiful. I love it. So well put. So, as always, we're going to leave it there. There's enough to digest, and
Yeah.
we'll touch base with you in 3, 4 months. And hopefully, this trend line continues and this conversation is an easy one like we had last time. So, as always, thank you so much for your time. We really appreciate you, and we'll check in soon.
Absolutely. Again, 3 months ago, it was scary, everybody, but we're in a lot better spot, and let's just be thankful for that. But thank you for having me back, Steve. I appreciate it.
All right, Ryan, be well.